Welcome back, everyone. We're diving into a topic today that may seem a little daunting at first, but stick with us. We're talking about economic recessions.
Those periods where things get a bit, well, rocky.
Exactly. And some experts are predicting a possible global downturn, potentially as early as 2025.
Sooner than many people might think.
Yeah, it definitely makes you think. But the good news is this deep dive isn't about freaking out or hiding. It's about giving you the knowledge and strategies to, not just survive, but actually thrive during a recession.
We're going to break it all down. The why, the how, and most importantly, what you can do.
So let's address the elephant in the room. Are recessions some kind of economic apocalypse? Like, should we all be stocking up on canned goods and building bunkers?
Haha, not quite. It's really crucial to understand that recessions are a natural part of the economic cycle. Think of it like breathing. You inhale, you exhale, economies expand, they contract.
It's cycle.
Exactly. And these contractions, these recessions, they actually help to correct any excesses that might have built up. Think of it like a system reboot for the economy.
So it's not necessarily a bad thing, more like a necessary adjustment.
Precisely. Understanding that cyclical pattern can help you remove that fear factor, It empowers you to plan proactively rather than just reacting out of panic. So let's look at the numbers. Between 1960 and now, the average economic expansion lasted about 5 to 7 years, followed by, you guessed it, a contraction.
And it's been a while since our last major downturn.
Makes you think, doesn't it?
It really does. Okay, so we've established that recessions are part of the cycle, and they kind of act like a reset button for the economy. But what actually causes these recessions? What throws things out of whack?
Well, there are a number of factors. High inflation, for one, or even its opposite, deflation. These can really disrupt that economic stability. Then you have rising interest rates.
Which make it more expensive to borrow money.
Right, slowing down investment and spending.
Makes sense. So we've got inflation, deflation, interest rates. What about debt? What role does that play in triggering a recession?
Debt is huge. Think of it this way. If individuals and businesses are carrying too much debt, what we call an over-leveraged credit system, it creates a very fragile environment. It's almost like building a house of cards, One wrong move and the whole thing could collapse.
Ooh, that's a powerful image. And I imagine unexpected global events can also throw a wrench in things.
Absolutely. Things like pandemics, like the one we all experienced recently, or geopolitical conflicts. These events, they can send shockwaves through the global economy, disrupt supply chains, impact trade, and really shake consumer confidence.
They can be unpredictable, for sure. Okay, so we've got this potential recession maybe on the horizon, and we've talked about some of the underlying causes. But are there any specific warning signs right now, like red flags waving that tell us it's really coming?
There are, and they're not just theories. We're actually seeing some of them play out right now in the real world.
Okay, now we're getting to the good stuff. Tell me more about these warning signs. What should we be looking out for?
One of the most reliable indicators is something called a yield curve inversion.
Okay, hold on. For those of us who aren't, financial experts, break that down for us. What is a yield curve inversion?
Sure. In simple terms, it means that short-term interest rates, what you might get on a short-term bond, are actually higher than long-term interest rates, like those on a 10-year bond.
So usually, shouldn't be the other way around.
Exactly. Typically, lenders expect higher returns for lending money over a longer period. When short-term rates are higher, it's almost like the market is saying, uh-oh, things are going to be rough in the near future. And historically, when this inversion happens, a recession often follows within 12 to 24 months.
So this yield curve inversion is a pretty big deal then. What's another warning sign we should be keeping an eye on?
Corporate debt levels. Businesses have been borrowing, at record levels in recent years. And while this can fuel growth when times are good, it creates a potential bubble that could burst if the economy slows down.
It's like too much of a good thing can sometimes backfire.
Exactly.
So if companies are carrying all this debt and suddenly their revenue drops, they might struggle to make their payments. Could that trigger a domino effect across the whole economy?
You got it. And that leads us to our third warning sign, rising layoffs. This one hits a little closer to home for a lot of people, and it's a very tangible sign that the economy might be heading for trouble.
It's like one of the first things we hear about when the economy starts to weaken.
Yeah. When companies start letting go of workers, it indicates they're anticipating a slowdown in demand for their products or services.
Which ultimately means a broader economic downturn.
Right. And increased unemployment, it not only impacts individual livelihoods, but also reduces overall consumer spending, further weakening the economy. It's a bit of a vicious cycle.
So we've got these three flashing red lights: yield curve inversion, high corporate debt, and rising layoffs. Not the most cheerful picture, but knowing all this, what can we actually do to prepare? How do we shift from this feeling of fear to a sense of, I don't know, opportunity?
It might seem daunting, but remember, the whole point of this deep dive is to empower you. Now that we've covered those warning signs and the potential risks, let's shift gears and talk about what you can do, not only to protect yourself, but to potentially even thrive during a recession. Think of it this way. A recession can be like a storm, If you're caught unprepared, yeah, it can cause a lot of damage. But if you've got a solid shelter, the right tools, you can weather that storm.
I like that analogy. So what are some of those tools? What can we do to build that shelter?
It's all about taking a two-pronged approach, really.
Okay.
Protecting what you already have and then looking for opportunities to grow.
Okay, let's start with protection. What are the key steps to safeguard our finances? What should we be focusing on?
First and foremost, you need a solid emergency fund. Aim to have, 6 to 12 month worth of living expenses saved up in ideally a high-yield savings account.
6 to 12 months. Woof. That sounds like a lot, especially with the cost of, well, everything these days.
It might seem daunting, but trust me, it's worth it. Having that cushion gives you peace of mind and the flexibility to navigate those unexpected challenges, whether it's a job loss, a medical emergency, or, yeah, even a recession.
It's about having that safety net, so we're not caught off guard. What else can we do to protect ourselves? What are some other proactive steps?
Take a close look at your spending habits.
Oh, yeah.
Now's the time to audit your expenses and really identify areas where you can cut back. Think about those subscription services you never use. Maybe eating out a little less.
Oh, yeah. I'm guilty of that.
You'd be surprised how much those little things can add up.
Yeah, I actually recently canceled a streaming service that I hadn't watched anything on it in months. And you know what? I don't even miss it. It's all about making those small adjustments, right?
Exactly. Small adjustments add up. And it's about being more intentional with your money. Cutting back, it doesn't have to mean depriving yourself, right? It's about making choices that align with your goals. So we've got the emergency fund, we've got our spending audit. Now what about investments? How do we protect those during a recession? I know a lot of people, myself included, get a little nervous when the market starts to wobble. What's the best approach there? This is where diversification comes into play. A fundamental principle of investing, especially during times of, uncertainty. Think of it like building a house. You wouldn't want to build it all out of one material, right? You'd use different materials, bricks, wood, concrete, for strength and stability.
Makes sense.
It's the same with your investments. Don't put all your eggs in one basket, so to speak. Instead of putting all your money in one asset class, like stocks, spread it out. Bonds, dividend-paying stocks, even gold.
So it's all about creating that balanced portfolio, one that can kind of weather different economic conditions.
Exactly. Historically, different asset classes perform differently during recessions. If you're invested in the stock market, consider dollar cost averaging.
Okay, now for those of us who are new to investing, can you break down dollar cost averaging? What does it actually mean?
Imagine you're buying, I don't know, apples. Would you rather buy all your apples at once, hoping to get the lowest price? Or would you buy a few apples each week, regardless of the price that week?
I see where you're going with this.
That's dollar cost averaging. Invest a fixed amount regularly, regardless of the market ups and downs. You average out your purchase price over time, reduces the impact of that market volatility.
It takes the emotion out of it, right?
Yeah.
Especially when things are uncertain. So we've talked about the protection side, emergency fund, spending, and diversification. Now let's talk about that second prong, thriving during a recession. Is that even possible?
Not only is it possible, but recessions often create very unique opportunities. Think about it. When everyone else is panicking, selling off assets, that's often when the best deals emerge. You just got to know where to look.
I like the way you think. So where do we look for these opportunities? What areas should we be focusing on?
One area is real estate. When the economy slows down, property prices tend to drop. So if you have the capital available, it can be a lucrative time to invest.
Buy low, as they say.
Uh-huh.
So it's about being ready to kind of strike when the iron is hot. What other opportunities might come up during a recession?
Recessions can also be a great time to invest in yourself.
Oh, interesting.
Think about learning new skills that are in high demand. Online courses, workshops, certifications. Upskilling, as they call it.
Yeah, it's like to say the best investment is in yourself.
Exactly.
What other areas should we be thinking about?
Think about side hustles. Economic slowdowns, they can create shifts in consumer behavior. New needs and niches emerge. This is where entrepreneurial folks can really shine. Identify those emerging needs and offer innovative solutions. You could create a successful side business that actually thrives during a recession.
It's not just about hunkering down and waiting for the storm to pass. It's about looking for the silver linings, those opportunities that might not have existed before.
Absolutely.
Do you have any examples of individuals or companies that not only survived but thrived during recessions? Stories that can inspire our listeners to think differently about things.
One of the most inspiring examples is Warren Buffett, legendary investor.
Yeah, I love a good Warren Buffett story.
Yeah.
What did he do during a recession? How did he approach things?
So during the 2008 recession, when fear was everywhere, markets were plummeting, he famously said, "Be fearful when others are greedy and greedy when others are fearful."
I've heard that quote.
Instead of panicking, selling off his assets, he used that opportunity to buy undervalued stocks. He saw that long-term potential and went against the tide. And those investments, well, they paid off big time. Proof that strategic thinking and that long-term perspective can really pay off, even during tough times.
It's a great reminder that recessions, yeah, they're disruptive, but they can also be full of opportunities if you know where to look. So as we wrap up our deep dive into recession readiness, what are the key takeaways for our listeners? What are the most important things you want them to remember?
I think it boils down to this. Recessions are a natural part of the economic cycle. It's not a question of if, but when. But understanding the causes, recognizing those warning signs, and having a solid plan can make all the difference.
Absolutely. We covered a lot today. Those red flags like the yield curve inversion, those rising layoffs, practical strategies for protecting your finances, like building that emergency fund and diversifying your investments. We even talked about those apples, a clever analogy for dollar cost averaging.
And we talked about that mindset shift from fear to opportunity. Recessions can create some unique openings in areas like real estate, upskilling, even starting that side hustle. Your next big idea could be born out of a challenging time.
That's a great way to look at it. I love that Warren Buffett example. Even in a downturn, there's potential for growth if you have the right mindset. It's about staying informed, being adaptable, and playing the long game.
Couldn't have said it better myself.
This has been so insightful. I feel much more prepared. Honestly, even a little excited about the possibilities that might come up during a recession. Not that we're wishing for one, of course, but realizing that with the right knowledge, you can not only weather the storm, but maybe even come out stronger.
That's the spirit. Knowledge is power, and you have the tools to face those economic challenges.
Before we sign off, I want to leave our listeners with a final thought. We talked about investing in real estate, in stocks, even in ourselves during a recession. But what about investing in our communities? How can we support each other and build a more resilient society as a whole, especially during those tough times?
That is such a great question, and one we could all benefit from thinking about. Maybe it's about supporting those local businesses, volunteering our time and skills, or just being more mindful of the needs of those around us. A little kindness can go a long way, especially when times are tough.
Love that. Tough times don't last, but smart strategies and strong communities do. Thanks for joining us on this deep dive, everyone. Until next time, stay curious, stay informed, and stay connected.